Thanks, Aditya. It's a pleasure to be with all the people here, and definitely a privilege to be borrowing people's time and talking to them on a Saturday evening. So I hope I make the most out of people's time. Uh, what we can do is, uh, at the cost of maybe just 1 minute or maybe two, if anybody wants to just speak up and share what exactly they expect from a session like this, more than happy to make notes. I have some thoughts that I want to share with everyone as a construct from a venture capital standpoint, and have a few slides, and not a lot, which I would like to run through. But if people have a specific expectation that they're looking forward to, more than happy for people to just unmute and share. The whole opportunity of being in a much smaller group allows us to make it highly interactive. So I'm more than happy to understand if people have a specific expectation and ask over the next 60 minutes. So I'll just take a couple of seconds of break, and if somebody wants to ask or put down their expectations, more than happy. And what we can also do is weave it and intersperse all of the expectations that come up in the next minute into the course of my uh, session. So I'll just wait for a couple of seconds and then we can start. If anybody wants to go ahead, please unmute and talk.
Uh, all right, so I will have to ask people to unmute. So guys, if you have questions, unmute yourself. If not, then keep yourself on mute. I'm just doing this thing. Once. Okay, I have unmuted you all. So anyone has anything to add here, please go ahead.
Done. No sweat. Thanks, Aditya. I don't think anybody is coming with specific ones, but yeah,
Okay.
so time and I go get going into the session straight away.
Super. Super.
Let me just give a very quick context on what we do so that people can appreciate where I'm coming from on making a few points. And at any point in time, we can also keep putting the chats in the chat box. So we'll try and be responsive on that as well if people don't want to talk or unmute. So over the last 10 years of Bloom, Sanjay Karthik and I are three partners at Bloom. And over the last 10 years, we have invested in almost 135, 40 early stage businesses. And some of the notable ones include the likes of Grey Orange Robotics, Unacademy, Purple, etc. So we have been investing both on the B2B side as well as on the B2C side, coming in probably as one of the first investors, if not the first investor, the first institutional investor on the cap table of a company. So it is with that context, I have prepared a few slides which I will take you all through. And venture business is a power law. So the session is also going to replicate that. So what I mean by that is, while there are a few slides, we will focus on the first couple of them in the maximum extent possible, and then others we will just breeze through it. And of course, there are two more sessions which will be taken by two other people who are experts on these matters, so that you get a variety of expectations and knowledge and understanding. So, with very quickly, just a background, like I said, we have raised three funds over the last 10 years on the core side where we come in early. And then a couple of funds uh, on the growth side where we come in relatively late, but into our own portfolio companies. So when we come in late, it's not that we look out for other companies to invest into. So that's a very quick background for all of you to appreciate some of the points that I am trying to make or going to make. So first and foremost, in the current context, I'm presuming that we'll have a mix of audience who are curious to know about venture capital, and there'll be those who are likely to invest or going to help others invest. It's going to be a hybrid mix. If there are some other constituents which I have not covered and you want me to cater to, please put in the chat box. More than happy to cover it. So broadly, early stage investing is a strategy. It is no longer just a small side bucket where people can dabble with a few investments. What we tell family offices when we meet. Uh, yeah, sorry, Gaurav, you're saying something? Okay. So, broadly, when we are meeting family offices and helping them take a call on investing, we are basically consciously reminding people uh, that this is a strategy broadly. It is no longer a small allocation that works with. So, it needs to be thought through in a fairly comprehensive manner where families and investors are allocating capital to this vertical. Most of the activity in this space is around tech, some activity around consumer oriented startups, but broadly it is about tech enabled businesses or consumer led businesses. This will what will constitute 95% plus of the universe. And when it comes to tech, it is no longer a vertical. Back 20 years ago, we used to talk about fundamental analysis, and as a part of fundamental analysis, we used to analyze tech as a vertical, where we would compare different companies and try and decide which of the 4, 5, 7 companies on the tech side is the best business to invest into. Life has come a long way, and we feel strongly that it is actually a horizontal platform and that is the only way growth is going to be more inclusive. For example's sake, can we imagine us having survived the pandemic without the aid of a tool like Zoom or any other video calling meeting network like Teams or most others which are there? I can't find ways and means to continue to do well if we didn't have access to these kind of tools. So broadly, it is the only way growth and development is going to be inclusive. And there are pockets around the world where development has not reached at the same level at which we see in our own cities or elsewhere in the world. And tech is hopefully going to be in a position to help us take that much forward. What that means for potential investors is that the timing, it's not too late. There is a school of thought which says that if Zomato is going to be a 1 lakh crore market cap business, is it already too late? Have you missed the bus? And my humble take is, no, you haven't. In fact, if we go back from a psychology of investing, people do tend to book IPO applications in a very exuberant manner. So same rule applies to startup also. If there is a concrete strategy that can be carved out by people, allocate capital in a meaningful way, it is definitely not too late. We are entering a phase which we do believe will last for the next 20 years. I'm not trying to say that the same price points will remain, the same multiples will remain. Price points will keep correcting itself. Every cycle, every once in 3 years, we will have the respective ups and downs that will be there because those things are driven by liquidity. But the fundamental demand and scope for technology related offerings, and companies that cater to consumers and enterprises with those offerings is definitely going to continue to rise, is all that I'm trying to say here. There's another point that people ask. It's partly related to the points that we have discussed. How mainstream it is. Is it still something which can be done on the sides? And my humble take is that tech is as mainstream as it can be. Uh, we are at a juncture where it is very much integral part of portfolios of most accomplished families outside of India, the larger families in India. And I don't see any reason why it should not be a certain percentage of the wealth locked up into the areas pertaining to tech investing. That's the only way one will be in a position to partake in the new economy. And personally, I have always said this, don't want to mince words. I'll verbatim repeat what I said on a couple of public forums that the whole opportunity for Indian families, Indian investors, rupee capital, basically, to participate in the early stage venture is actually an opportunity for wealth maximization as a country. And if the government doesn't do all that it takes to make it possible, if we as investors don't do meaningful work around it so that we are raising rupee capital, I think then we are once again looking at becoming a digital colony. Pardon my harsh words here, but yeah, that's broadly the game. Because when you take a look at examples like, let's say, Flipkart, uh, just to give a perspective, the investors or the shareholders who made wealth, the only set of people who benefited from India are the founders and the employees who held ESOPs. Otherwise, Flipkart didn't have a single shareholder who was an Indian shareholder. Of course, the government made taxes, and they have managed to get a bountiful from that exit transaction. But that is not what will help in wealth formation. That's good. That's the government's job, and I'm happy that they'll collect taxes. But at the end of the day, private wealth formation is very, very fundamental for a country like us. So, if that is true, and if broadly we have consensus in this group that this is what is a fact, then what are the ways in which one can invest? So, broadly, there are two ways to go about investing on the tech side. One is the active investing front, and the other is passive investing. So, on the passive investing, similar to what people do with respect to mutual funds, and active investing is when you're directly taking exposures with respect to startups and making calls directly into primary into company rather than investing in through a fund. And just a quick few moments on pros and cons of both of them before we move ahead. So when it comes to investments uh, from a fund standpoint, it is meant for people who are going to be looking at allocating a certain capital and basically using it as a strategy to allocate a part of the money on a disciplined basis. And when it comes to active investing, it is a different ball game altogether, where one is looking at becoming an investor and go deep into the space and try and go deeper into understanding what does it look like to run a company on the B2B side, or what does it look like to run a company on the B2C side, have a deeper understanding of the verticals that are going to work, not get caught up into buzzwords that are doing rounds in the ecosystem, and make fundamental grounds of call for making investments into startups. So active investing in listed companies, a lot of people do that. There is even there is a fair bit of information arbitrage where people are not fully aware as to what's happening beyond the top 100 or beyond the top 200 companies. On the other hand, when it comes to investing on the private side, the information asymmetry and the information arbitrage is even is much higher. So one can go after company and say that, okay, I'm investing in a company X. Let's say you invest in this business called Apna Club, and you have made that investment not fully knowing that there is possibly a large company which has been deeply funded by a competitor, which could possibly impact the performance of this company. It is not always driven by fundamentals on the early stage side. There are enough moments where a company may be doing incredibly well. Like, for example, an Exotel is a company in Point, which is a Bloom portfolio company, where for the longest time, the company hadn't moved its valuation benchmark in the portfolio. And the simple reason was it had not managed to attract an investor on the following round. And the fact of the matter was that the performance of the company was stellar all through the last 9 years. It had reached a point where it was paying more taxes than the capital it raised at the time of the fundraise about 9 years ago. So that's the kind of performance it had. And suddenly then it got interest and momentum, and things are now at a point where it should be. It is still lesser than what it should be, but yeah, it is definitely much better than what it was. lesser than what it could have been. So broadly, there is going to be a fair bit of information asymmetry on the private side, and therefore we always feel that for most people who are into full-time businesses or full-time into their own activities, the passive investing by way of allocating capital to a fund possibly is the right way to go. And the question that begs answering is, why is it that one can't allocate time and look at passive active investing? I gave a couple of examples earlier. The in the early stage, on the early stage investment front, it's as much of involvement and understanding the company and the sector as it is to invest the founder. In fact, one needs to have devoted a fair bit of time so that one understands and empathizes with the founder, because early stage investing is all about the founder journeys. And if you're not going to be able to allocate clear end goals, why you're doing what you're doing, clear sectors in mind, one tends to get caught up into flavors of the season, reading on the what the press is saying or what the internet is talking about or what buzz is there on Twitter, and allocating capital, which may or may not really be the most relevant way of looking at it. Another very important fact of early stage investing is also that when we look at founders, we are, yes, going and making a call that we like the founder and therefore giving money to them. But fact of the matter is that the founders are selecting the investors as much as the investors are selecting the founder. It's a mutual selection, and there is this orientation among the founders to go and talk to the best of investors in the market, and if they're able to raise from that category, the lesser known investors may never end up seeing a high quality company. I don't mean to say that you will never have high quality access. There are enough people who we have met in the last 5 years who have told us that they have had a very interesting venture portfolio. And we have seen that they have gone down the path of doing a reasonably good job, the overall IRRs and portfolio at their level. But those cases are far and few in between. So one needs to be wary of the founder selection, self-selection. Also, it is about a consistent value add. When an early stage company is asking for capital, there also is a fair bit of expectation for people to help the founders. And as investors, there is also a case or a need for founders to for investors to support the founder. That could be by expanding Rolodexes, by connecting to various people, helping them in the follow-on fundraisers, which may not always be possible for a smaller setup, which otherwise is a full-time job and a full-time business, but does venture investing as a part-time activity. So that overall three-pronged issues of time and attention, setting up clear goals, self-selection, understanding the founder mindset, all of these put together broadly would mean that it's best for the founders to be understood better and let the active investors do a good job of it, and those who are not fully active can play it to the funds. So broadly, yeah, on that note, let us give people a perspective. Let me give people a perspective on how does an early stage investing work, what has been our experience around the early stage investing. And then happy to also happy to pause here and take in a few questions, if at all, and then happy to pause, go through the rest of the slides. Okay, so given we don't have questions, let's go into how the whole thing works. So some of you possibly may be aware, a few who are not, will just quickly rush through some of these basics. So typically how VCs work, and this can be a very similar framework for family offices and other early stage investors as well, where you are investing into a startup, and then there is a carry that an investor pays to a fund. So basically, the fund aggregates capital from all its investors and ends up charging the investors a recurring annual fee. And at the end of it, when they have returned back all the money, there is a share that the investors will have, what is known as typically as carried interest, where they charge about 20% of the gains as their reward for making the whole investment successful. So primarily at this early stage side, there will be multiple players. First and foremost, there will be angels who are pretty much happy to come into a company at a very early stage. The company may not have really a plan here, and most of the angels, or super angels as they are called, would end up making an investment over a meeting, and they'll make a decision to allocate maybe 10 lakhs, 20 lakhs, 50 lakhs, and sometimes even as high as a couple of crores. And for this kind of an investment, they will expect a very chunky stake in the company. Chunky stake could be as high as about 5, 10, 15%. Anything more than that for an amount less than a crore or two is definitely a big stretch. There are people in the market who would end up investing maybe, let's say, 50 lakhs or a crore and end up taking 25, 30%. That is very, very unreasonable. Once in a while, we do come across a company which is doing well, and the founder basically shares that on the cap table is an angel investor who is sitting on 25 or 30%. Well, yes, there is a risk. So there's an argument that the investor holds that stake because they came in very early when no one else was trusting the company. But there are challenges because as the company raises more rounds of capital, and if every investor will end up asking for 20 or 30, the founder stake will be left to very low number very, very quickly. And that does affect the prospects of the company at a later stage. The next set of category of people are people like us who will typically come in post maybe an angel investor coming in. And this will include some people on this call or some clients of some people on this call. It will include family offices, structured funds like us, and some of the larger investors also once in a while come in and play fairly early. So there's a tendency, early stage is broadly like a uh, sports match where everybody has a view, and even a large family which may have chunky ticket sizes that they invest in once in a while will allocate a 1, 2, 3 crores in the company. So early stage is fairly competitive, and there are implications of this competition. It reflects in the way price rounds are priced in a company or companies are valued. It reflects in the fact that the ecosystem is very vibrant. It also reflects in the fact that there is much more access for founders who are doing a good job to raise money from. And this has all changed very, very significantly over the last 10 years. 10 years ago, I can remember the number of investors on the early stage side, angel and pre-A, were literally handful. And from that standpoint till date, I think the market has more than quadrupled. And as some of the families have also gone into the next step where they've started to raise third-party capital. They are not only investing their own capital, but they are going down this path of investing third-party capital where they are raising from their own networks and friends and families, etc., and aggregating into a SEBI-registered structure and making investments. So here, the call that families are taking is when you start making a call to invest actively, what is happening is that you agree that you are going to source interesting startups. And sourcing interesting startups is as much as startups coming directly to you as a first port of call versus you always reaching out to companies and figuring out what's happening. There is a clear bias for entrepreneurs. There are two categories of entrepreneurs. Category one of entrepreneurs are those who are savvy people who have created a startup in their earlier avatar, have exited those startups, and now have come in on to start something again. These people are typically going to be fairly expensive. They will ask for a premium. They will try and make sure that they walk up to the institutional investors who they believe can come in with deeper checks as they need more money over the next 2, 3, 4 years, who can support them, who can help them. So when it comes to sourcing, there has to be a certain brand of the investors as well, And we are now in this era where even within a single outfit, the individual investors in those firms, or for that matter, family offices, becomes very crucial. The marketplace is now much more integrated than before. Until 3, 4, 5 years ago, it was very possible. We have seen enough cases on how some of the investors end up behaving. We have seen cases where founders end up getting treated pretty badly, and the word now reaches pretty thick and fast. So, for investors, be it a VC like us, be it a family, be it an individual, that whole ability to understand the founder mindset and the founder perspectives, and trying to be empathetic, and then go after and differentiate between the founder who is not the right choice versus the bulk of the founders who may be having the right intentions, becomes very, very crucial. And once you have done the enough work on creating the best access for yourself, where you end up getting the best of the pipeline in the country, then half the job is done. Because the whole effort around the early stage investing is going to be the founder selection, the work that you do post investment, and the ability to generate exit outcomes. So if these three functions can be done well, I think then one is home, and then one is definitely in a much better position to invest fairly earlier on in the business and do that on a full-time basis. I've used this word a couple of times about value add post investing, about helping the companies. So let me spend just about a minute or two on what I mean by this phrase of value add or helping the company. So and again, there's two schools of thought. There is one school of thought which says that if I'm investing in a company, if I'm investing in the best of founders, should I not expect that the founder should know everything and do a good job? Yes, it's a reasonable thought. But at the same time, the difference between a good outcome and a great outcome sometimes is the investors. So, by and large, if the founder choice is right, if they have gone and done a good job of execution, they have been prudent, and they have evolved in times of stress, then it boils down to how the investors are able to attract other investors, how they will to collaborate and support the company. So, for example, what we did about 8 years ago, we incubated this business so that we could help our companies with respect to the operating services. A few years later, we ended up adding hiring as a service. So our founders end up having access to finance, legal. There are hundreds of things that the founder deals with on the early stage side. Can we make it convenient for the founder to have all of those access right at the early stage into a repository, and also be able to talk to people who can have all the answers that they need? So we incubated this team, and this team, from what it was 3 members, has managed to scale to about 45, 50 people. And I think that has become a powerful way for us to collaborate with the founders and support them in their times of need. So I'm not saying that that's the only way to do it. There could still be a fund which does a good job at par with what we have delivered, and everybody will look at us and say, why did you do all this jam and create a massive platform offering? Well, fundamentally, we do believe that by investing, the job has begun, and not the job is not half done. It's not about two functions. It's not about just investing and exit. What we do in between the investment and the exit sometimes determines the fate of the fund. And by and large, that we believe that it should be a difference between a fund that did well versus a fund that did incredibly well. So that's why we always advocate the platform as an approach. I'll just skip the next few slides, which talks about the history of venture capital. Just a fact point that today, when you take a look at the highest of market caps in companies, bulk of them are venture funded. You take a look at the top 10 businesses in the market. And India will not be very different over the next 5 years. So, just a quick acknowledgement. Nothing that I have said leads anybody to believe, I hope, that it's a safe investment. And now I'll take a step further and clarify that yes, it is a very risky investment. And it is because of this that in a venture capital, people allocate single digit as a percentage of the overall portfolio, but people expect the highest possible returns. So typically, a family office should expect a 25% net return from their venture capital managers. Or they're investing directly, they should expect between 25 and 30% as the overall return from the portfolio. And there can be enough opportunities where we can make more. In China, in the US, there are funds which are there which have delivered upwards of 35-40% IRR in dollar terms. So I don't see India to be any different over the next decade or so. But just to put a base case there, I do feel that it is only fair that the investors are delivered a 25% net investment. I'm just seeing the question on the chat group. Amit asked, "What's the main difference between us and angel networks so far as the early stage is concerned?" So, Amit, not much. We do end up doing similar stage investments. When some investment has come on to list on an angel platform, rest assured that there is a 7 on 10 or possibly an 8 on 10 chance that it would have done the rounds with a venture capital fund. It's by and large the pecking order in the Indian market, Amit, is fairly established, where people will try and reach out to high quality institutions, and within the institutions also there's a pecking order where people try to reach out to the top 5 or top 10. And in the ecosystem it's not too hard, because you can take safely that between the top 10 funds in the country there will be about 1,000 companies which don't overlap across multiple funds, unique companies, which have been funded over the last 12, 10, 12, 14 years. So, reaching out through one of their portfolio companies and talk to the investors is really the game, because we as investors have already understood our founders and trust them, and those founders have also known us. They know what we do, they know why we do what we do, and there is a much better chance of and a notice being taken for a warm introduction which comes from people who are within. Not to suggest, each year we do end up getting about a deal for over 2.5 to 3,000, and there'll be people who we will invest which have not come through our own founders or people within the network. But there's definitely a fair bit of validation in the ecosystem, and it's a small ecosystem, it's not a massively big ecosystem. So people will try and prefer to go to the top 10 funds, failing which others, and then associations and networks and all that. There is also sometimes a good reason why people go to a network. Let's say the angel investor from who you have taken the money is a very, very active investor, very well known in the early stage circuit, and they are part of the angel listing platform or a network platform, and they advise that, okay, if you list there, I'm going to help you get some more investment. I'm going to make sure that you're marketed well and people end up joining you. So sometimes it is that also as a factor, but largely, I mean, we are not very different. We do end up seeing the same class of assets. The fundamental difference, though, is that we come with a single check, so it is largest check, and then we support the company extensively over the future, which is not what an angel fund will largely do. The angel fund is largely going to come in at that point in time in the company for the first round, and post that they will be by and large passive. So there is going to be difference on what we do and how we do post investment. From a deal flow perspective, it is not very different. So moving a little ahead in terms of the overall approach investors end up taking. So just to finish the follow-on point, so all the 2.5 to 3,000 investments, how many do we finally select? So annually we are looking at making about 8 to 10, maybe 12 investments in a year. Outside of the core checks, we might do very tiny checks, maybe about 10 or 12 of those. So all in all, not more than 15, 20 investments anyway. So that's broadly the funnel that it boils down to. So broadly, from a funnel point of view, there's a 2.5 to 3,000 plus that's come in. We try and do justice by making sure that somebody in the team goes through all the proposals, all the decks, try and maximize on the meetings that we can do, and then finally say no or a yes. Uh, so how do returns stack up? And let me just, before people end up getting hung up on the slide in front of the screen, let me just shut the PPT off for 2 minutes and spend a couple of minutes talking about it. So broadly, when people are going to create a portfolio, what happens is, let's say somebody creates a portfolio of 30 companies, or maybe 40 companies, or it could even be a little more. In a scenario like that, what happens is one does end up being in a scenario where the top 5, 6, or 7 companies will end up making almost 85 to 90% plus of the return that the fund delivers. And this is true for angel portfolios as well. So what I'm trying to say here is that there's a power law at play. And when it comes to the overall modeling of the fund, like you can see on the screen, which I just brought about again, the number of opportunities which will deliver a mega exit are literally far and few, roughly about 6%, which means if one has a portfolio of 30 investments, there will be 2 companies that will be delivering more than 10x of the money invested. Then there'll be a significant number, at least 50%, which are not going to return much. Let's say 0. And everything rest is between maybe about that 1x capital back to about 5x. So what we're trying to say here is 50% won't return anything. And then there is going to be only 6% that are going to deliver a mega outcome. So what comes out of this? What becomes super crucial here? What becomes important in cases like this is the ability of the investor to double down on his winners, which is a rarity for a family office. What also happens in a lot of occasions is the family or individual or even a fund once in a while may want to invest much more money, and the founder comes back and says, look, I'm already diluted a lot. So why are you forcing to invest a lot more money? Can you avoid investing too much? I would be grateful if you can pass on your pro rata. And one can always argue, and this has been a case of hard won for many an investor, where people have said, I have a right to invest deep into the company. Why should I give up investing in that company just because the founder is saying so? And one must appreciate in a point like time like this that the company, if it has to do a good job, will end up being successful only if the company is able to continuously attract high quality investors on the cap table time to time. And imagine if all the early investors end up making investments which are pro rata always, then the founders will pretty much be down to about single digits even before they become half a unicorn. And which is where there is an inherent bias for founders to choose larger families or family offices or larger investors, because they know that they can play deep and they can signal much more emphatically. So, but yeah, there are cases in India where some of the families have done an incredible job of creating a very sound setup, an image where they have reciprocated with the founders' understanding of the business, and supported them through the thick and the thin. So these families and these investors as funds will definitely end up getting a significantly more or greater love from the founders when it comes down to selecting their investors. So that is broadly the construct on the power law. And like I said, the returns in the end state, those top 6% may have costed maybe about 5% or 10% from an overall portfolio, but it's these that are going to deliver an end state of 60% or 75% of the fund in the final stages. So that is broadly what the VC power law means. In terms of legal structures on the back of which people can invest, If you're investing in a fund, it's straight away very simple. And investments will happen into a fund. Your money goes into a trust, which has been formulated by the fund manager, and then will get pooled with a SEBI license and go into investments from about that. And on the other hand, if a family has been not investing directly, it is actually investing through their own family channels, then it is about investing from a LLP or a corporate entity or any other format which is found acceptable by these companies. So broadly, the from an overall thematic point of view, what we have seen as a common practice is that the family offices or individual investors either create an LLP through which they invest, or if their capital is locked up into a private limited company, they use that. But if you are to ask me as to what is the best way to do something like this, my suggestion always is that either do it through a trust or do it through an LLP entity so that it becomes very clean. But the important point here is you can't really, there is a pattern where you take multiple investors and pool their money, and they are going to bring all the capital into an LLP to take it forward. That is something which is avoidable. And the reason I would say that is highly avoidable is because they are being viewed as a round tripping. So if investors are going to pool money without the approval of SEBI, the SEBI doesn't like this too much, and it is viewed that you are not following the regulations under AIF and all that. You are pooling money, and if you have to pool in money, you need to make sure that you have taken the SEBI approval. So broadly, this is where the overall regulatory framework in India is, and it is because of some very hard conditions. What ends up happening is that Indian investors don't get access to two of the most powerful things. Indian investors don't have the ability to get access to foreign domiciled companies in where it is run by an Indian founder, where they are creating entities overseas for the right reason. And the other thing that Indian investors end up getting missed out on is co-investment opportunities. Some families are investors who invest 5% of the fund size into a single fund. They don't end up getting access to co-investments because in India it is very, very difficult to pool in money, and the investors typically want to do these things, but the laws don't permit. The reason why founders end up creating companies overseas is because these founders are trying to cater to a global market. And no matter how much this government has tried, to a large extent, they have been successful in improving the brand image of India. However, a lot of things on the ground continue to operate in a certain way, which don't give a lot of comfort to some of the investors in certain type of businesses. We are seeing a very strong change of undercurrents from the regulatory side. A lot of it is positive. A lot of it is positive. Some of it continues to be the way it was a few years ago. So I think as more and more of these changes continue to happen, there will be a favorable climate for people to incorporate here. But till then, businesses which require a certain amount of IP protection or business of a global nature where the founder is going to be individuals based overseas, there will be a tendency to create an entity outside of India because the entire value is being created there. Indian arm is just an outsourcing arm for creating a backbone and the technology management and the infrastructure, etc. But the real value is happening out there in terms of the strategy and the overall flow, sales, etc. So Indian investors can't do LRS investments and wire monies into those companies if they have Indian subsidiary. So that ends up creating a round tripping issue. And there is a limit on the LRS also. So yes, you're allowed $250,000, but the opportunity is much bigger than that. So yeah, these are the two things that ends up getting missed out. That said, I do believe very, very convincingly, which is why we also run Indian funds. If we didn't believe that, we would not have done that. We do believe that India has a massive opportunity base and there can be enough opportunities to deliver meaningful wealth creation, standing here and being here as well. So to the extent possible, yeah, one can use the LRS, one can use the other structures, but you're missing something. But it's not that you're missing hell of a lot and India doesn't have any opportunity at all. So we are in a good balance, much better than where we were a decade ago. But yeah, we have a lot of distance to travel before we can say that yeah, we are the most business friendly or we are the most investment friendly destinations. And there are enough points to talk about. This is not the right forum for me to elaborate on that. So this is broadly the overall structure for people who want to start investing. The stages of evolution of a startup, uh, just on a lighter note, uh, you see this chart. It's self-explanatory, and I'll quickly jump to the next one. So, in terms of the thought process, uh, when we are beginning, it's just a company at times, just a team, and one must acknowledge that ideas are not at a premium. The innovation is not necessarily only in the idea. Sometimes it's also in the execution. So if there is an IP involved, yes, it can be idea is crucial, innovation is crucial. But otherwise, some plays which are India centric or which are targeting the Indian consumer end up being a platform where there is going to be a fair bit of chaos, competition, and execution is what matters. So, in typical stages, early stages, all about investing when the company doesn't have a first customer, or more than maybe two, three, four customers at the enterprise level, and a few tens of downloads at the customer level. So, the whole ability to try and envisage a value or try and imagine this to be a much bigger outcome is incredibly hard. So there is this advice that the first money should be taken to create a minimum viable product, a product which will be ready to go to the market, and it need not be a perfect product. That's a step one. There will be significant evolution, it will happen over the next 12 months, and the product will become better. But might as well do a product which is functional, which allows you to go to a few investors and raise money, which allows you to go to a few customers. And at the end of the day, not that there are any founders on this room in this room, but yeah, when we are talking to potential founders or young founders, we always make this point that the best source of money is still the customer and not the investor. So it is important to hit the market, seek the customer feedback, improve on the MVP, and get into a phase of a predictability on the sales chart. And if there is a predictability on the sales chart and we're investing at that point in time, either we will end up paying a huge premium or we will not be able to get access because we're very late already. So early stage is all about picking those trends in the market and going down the path of making a call with conviction, which is that I go back to the point earlier. It's about having a full-time orientation. And at the end of the day, the risk starts coming down when the company loads more and more customers, and the risk comes down disproportionately. So which is why you see that on the early stage side, sometimes the valuations are as steep as they are, because the founder suddenly after 1 year says, I have 4 paying customers, I don't think I will die if I don't raise money, let me raise it as a big premium only, if somebody comes, great, otherwise no problem. So that is also an approach that a lot of investors encourage their founders to take. So the mortality rates are pretty high, like I said earlier. 50% of the companies won't deliver anything. And this is after we have funded these companies. Uh, One can say that, okay, so it is broadly a gamble. Well, I don't feel so. There's a method to the madness, and which is why we have jobs where large formats, sovereign funds, and all will also give money to us. When I say us, I don't mean just about Bloom. I mean broadly the ecosystem of all the homegrown managers over the last 5, 7, 8, 10 years who have done an incredible job. So, what we also advise founders is that uh, you need to tread carefully between a crazy high burn, investing heavily in the tech of the future. Because when it comes to raising money, each round of investor wants to see something meaningful that has been delivered by the founder. And if they don't see that the founders move significant every 6 months, the tendency is to not to look at the company. And in such cases, even the best of the companies get overlooked at times. So it is not that the best of the companies are hot companies. It's also that the best of the companies may be under the radar. They're hustling, they're executing, and VCs are not yet discovered it. So broadly, that is how the risk-return trade-off happens. Valuation, we can talk about it later if we have to. Don't want to take away too much of time. So broadly, the last point that I would like to cover in the next 5 minutes before I bring it open for deep Q&A is broadly how do we evaluate an early stage investment? There is not a formula. There are a few constraints. Uh, we are in this business of taking inordinate quantums of risk, and we want to make crazy amount of money. The thought process is the probability of success may be small, but the probability that once successful, the business becomes a big company in the portfolio has to be very high. If it is not, then the fund will not, or the portfolio will not make a phenomenal return. And more often than not, as individuals, as families, we do come across people of our own investors who call up and say, I have a moral obligation. Should I invest in a sector like this? Is it I want to give back to the society? Venture investing itself is a form of giving back, because when more and more venture funds get raised, we are fueling innovation, we are creating jobs. That's a much bigger primary investment that happens as compared to the many a times in the listed markets in some of the other countries. And we are at a point in India where something similar will also start happening. So one has to be careful that, yeah, it is for a cause. You can allocate a little more. It's social service, but yeah, one should invest only if it is going to make it off. It is going to be in the midst of a lot of constraints. We try and avoid investing in multiple companies in the same sector, more so when they're competing with each other. We try and develop a specialization where we say that we will not invest if it is not a part of our core idea, which is where within the fund also there is a specialization within team members. So large family offices need to replicate something like that. And the time period for which investments are made is invariably about 6, 7, 8 years, sometimes even 10. The idea is to go in after very large markets. The idea is not to go in for small niche markets. Yes, as an angel, one can afford to invest into very many niche marketplace, because it could become a lifestyle business and investors may not have a lot of problem with it. But broadly, yeah, as funds, we typically avoid those things. So broadly, yeah, that's about it. I'll just stop here and just wait for more questions and take a couple of questions. If there are specifics, more than happy to elaborate anything that I've spoken as well. Thanks, everyone.
Guys, can put up any thoughts on this? Happy to read it for you. Ashish, there are a few questions. I hope you've already taken those.
Sorry, Aditya, you're saying something?
I'm saying there are a few questions in the chat window. I'm not sure if you've taken those already.
I think I covered most of them.
Yeah. So, guys, any more questions?
Covered round tripping. So there's a question just come in. Just a minute. Yogita has asked a question. So if an Indian company funds a startup which is based out of India, suppose if the Indian company wants to bring the innovative
प्रोग्राम बोलना हम लेट तो नहीं हो गए
So suppose if the Indian company wants to bring their product to India for the company's own use, is it possible for the Indian company? No. So round tripping, Yogita, is not about the company's operations. As an investor, it is not advisable to invest in the company which is overseas, such that the money comes back into India. When investment happens from India into a foreign company, the money should be utilized outside. And so far as this condition is met, all other things are possible. How do you see the upside from here on from places like Zomato? So I think, like I said the other day on a public forum, uh, the demand for these plays is fundamental driven. The pricing is momentum driven. So for people who are long-term oriented, think about investing as a five-year cycle, who are constantly allocating money systematically into the early stage space on the tech side, etc. It's all good. But momentarily, at some point in time, market will cool down a bit. It's not that we will have a crash. Fundamentally, there are two or three things. We are seeing a fair bit of surge of flows in India. There are alternative avenues have started to stagnate a bit. There is a fair bit of stagnation happening in China due to multiple issues. It's not just the India-China issue. There are multiple other challenges as well. So we are beneficiaries of that. And I would say let's make hay while the sun shines. But I would never advise anybody to be overweight on a tech portfolio or startup portfolio. So far as you're allocating single digit percentage, upper single digit, I think that's definitely fine. The next one is practices a family office can follow to manage the angel investments. Good way to work with funds. Two ways broadly. One is that identify a good fund partner, invest with a fund. Otherwise, there's no reason or a motivation for a fund to engage with the family there. So if you invest with a fund, you will end up accessing the reports once in a while. You will reach the fund manager or one of their other partners, and you can exchange notes, learn, read the reports, attend their events. At their events, you'll be able to access their portfolio companies. So the engagement starts happening. And in those cases, the fund manager may not care. You might end up saying that, okay, I like this portfolio company now. I met him at an event of Bloom, which was there where Bloom had invited me. And I made an angel investment in that company also. So it's all about how we have been able to cultivate that brand. So the engagement will start with an investment. Most good funds will not entertain relationships unless somebody has invested meaningfully with them. And then you can say, okay, I would like to be in touch. From very large family format families also co-invest, where they say, I'm putting in 5% of your fund value, or maybe 4%. I want to make sure that whenever in the future there's a chance, on a best effort basis, you show me the opportunity, I would like to invest with you. Because you have the best pipeline, I don't have the best pipeline as a family office, so I'll tag along with you. So there are both ways which are possible. Ravindran has a question. Would you view a company with 5 years existence, a track record, would they fit into your selection? No, I think it's not. It's a stage at which the company is and the performance which matters. If it's a company which is doing well, but they're still okay to raise, which is in the sweet spot of the fund, it's still fine. In terms of how can one engage with us, look, we are accessible on emails. Feel free to reach out to us. More than happy to engage. So yeah, broadly, I think I have answered all the questions, Aditya.